what has happened since the last cuddle? Not much. So a lot of people are starting to get a little bit worried, and it's weird. When RT started to get a bit worried about, oh, crypto's not going to go up this year or next year, weirdly, this popped up on my, feed, whatever, and yeah, I just bought it, and it came as a pair. So, but yeah. But the thing is, you really shouldn't worry. Like, this is going to be, as I said, the last predictable rally. I cannot stress how much liquidity is going to be spaffing into the market next year. We've got election bollocks that's happening at the moment. Trump had another assassination attempt, which weirdly the media is not really covering that much, but yeah, they caught him. I did a bad sidestep, but all seem to have recovered now. Who else did a bad sidestep?
How bad was it?
I jumped out a bit of the pot. What was it like?
Local low, basically.
It was, yeah, 240-ish, and then I got back in at 310-ish. Yeah. So bad sidestep, but that happens. My rate prediction came true. So for the last year and a bit, I was like, we will have rates being slashed, and they just did a 0.5% cut, which is good. Hey. Long time no see, Joe.
Hi.
Other than that, not much has really happened literally last month. It was August, the last cuddle, so yeah. Now, a lot of these slides haven't changed. A lot of them, but a couple have. So we've got the big ones. So interest rates. Weirdly, the Fed hasn't updated their Fed funds rate chart. It takes months for them to pull a finger out of their ass. But everything else is still the same. So for those, who wasn't at the last cuddle? Holy shit. Okay, I won't breeze over these then. Some of you may not have seen these then. So this is US interest rates. As you can see, these dark, sort of, on my laptop it's grey. I don't know what it looks like for you back there. But yeah, they're these grey recession areas. Yeah, so every single time, you've heard me say this loads, but every time we've seen a massive hike of rates, it always leads into a crash once they start cutting rates. And that's always been the thing. Whenever there's a plateau, every single time the stock, we've had a rate plateau, stocks have melted upwards, which is exactly what we've seen with the current plateau. But the moment they start cutting rates, crashes start to happen every single time. And then also when you tally in the local lows for unemployment, every single time you see rising of rates and a local low of unemployment, then shit hits the fan. And then when you look at inflation, which is the green one over here, it all leads to the same thing. So every single time we see a hiking in inflation rates, local low of unemployment, we have a crash. So I'm very confident that there will be a crash at some point in the next 1 to 15 months. So could we save questions? At the last cuddle we had questions constantly, and so could you just save it? We will have a Q&A. So this one is also just to reinforce the unemployment thing. So every single time, so this is the U1 figure, but again, it says the same thing. Every single time we have a local low in unemployment, it always spikes up into a crash. Now, a lot of people talk about the PMI Purchasing Managers Index. Everyone keeps prodding me, and this is basically a side effect of the liquidity cycle. So what happens is we have the 5 to 6 year liquidity cycle, because most of global debt are on 5-year terms. So yes, we have the 2-year, 10-year, 20-year big treasuries, but most of global debt is corporate, and it's normally on 5 to 6 year terms. So the Purchasing Managers Index always coincides with the liquidity cycle, because the PMI is basically relative or middle to high level managers buying stuff for their company. So if you're working for BMW, you need to buy stuff, you buy it from India, China, yada, yada, yada. Hey, David, please grab a seat somewhere, anywhere. So the PMI lags the liquidity cycle just a little bit, but as you can see, it ebbs and flows. It literally goes up and down like clockwork from 1943 onwards. So if we zoom into the last bunch of ones, so these big lines here are the halvings, and you'll see that crypto and the PMI are coincidentally locked on top of each other. And that's only because the liquidity cycle rules everything and crypto follows liquidity. And so if you look at this over here, we've had the halving, and from now on we should see the PMI start to go up. So this seems contradictory to what the mainstream news are somewhat saying, because it looks all doom and gloom at the moment, but we should have a nice sort of little spurt to global economy, just a little one, barring anything going wrong anytime soon. Now, this is a US 10-year yield from the last cuddle a month and a bit ago, and I've been waiting for a bunch of months now for this to start crashing. When this starts crashing, you can see that the bond market's going to have a bit of trouble, and literally in a month and a half, we've had the first big move down, and that's only because interest rates have been cut. So the reason I was expecting this to come crashing down is because when rates start crashing down, so too will the yield. Sort of makes sense. But this is the real scary one. The spread between the 10-year and the 2-year has for a long time been my big crash indicator. And every single time we've hit zero and then bounced back up, we've had a crash. Now, I've put this sort of what I've called the danger zone for a while. And even when we're down here, I was like, we've got nothing to worry about, folks, until we get to the danger zone, which is that little circle there. And I've put my ghost feed. This blue stuff is what I thought the price action would look like for this chart. This was the last cuddle, and we were down here, minus 0.19. As of last night, we've gone shooting way back up. We're getting close, right? So this is, shit, the iceberg is right there, and we're about to hit it.
Can you elaborate? So, I'm not quite sure what you're trying to say.
Can we go to the Q&A later? We just want to bunch all the questions today, because last cuddle, I think I was an hour and a bit over schedule, and we were very late for lunch and dinner. So we'll keep it for the Q&A. So what I've done is I've superimposed the S&P 500. So this basically gives you an idea of what tends to happen. So if we go back to this one, the first time it hits the sort of the danger zone, the markets were already falling. So this is sorry, I got myself confused here. So the black stuff is the S&P 500. So this was the first proper yield inversion that went really negative, just like we had over here. This is the tech bubble crash. Got to the danger zone, and look, the market was already crashing by the time it hit that. So by the time it got in here, the S&P had already taken a bit of a tumble. The next time we had the yield inversion was here, and look, the market was already starting to top out. And then the other time we hit it here, again, we had that was the COVID crash. So it really did spike up. And now we're sort of getting there. So I wouldn't be at all surprised to see stocks start to do a bit of NDV, non-directional volatility, where we stop with the melting up and we start having lots of volatility, but going sideways. But yeah, and then crashes tend to take about a year, typically. Whenever you look at past crashes, so here's the thing, crashes are compressing. So because there's so much debt in the system now, and the interest-only repayments are just going nuts, the interest-only repayments are becoming a bigger percentage of US GDP, or not even GDP, US income, because they have to pay the interest-only from the income, not GDP. GDP is like a big, fluffy figure that doesn't really mean anything. But when you look at the US net receipts, as in the income it generates from taxes and whatnot, the US makes about, 3.8 to 4 trillion a year, and interest-only repayments are, the Fed are very lagging. The last the current figure we have is 1.1 trillion, but it's more likely to be about 1.5 trillion when they revise it very soon. So they don't have much of a choice here. So what's happening is that because everything's so connected since LTCM went bust, and I talked about that on the trading pub a couple of weeks ago, crashes are being a lot shorter. So if you extend the S&P 500 back to, as far as you want, crashes used to be 2 years, 2.5 years long, then 2 years, a year and a half. And the last big one we had was the COVID crash, where the world literally stood still for a bit. It was forced to stand still with lockdowns and stuff like that. And we had probably one of the quickest recoveries we've ever had in terms of, it was literally a V reversal. So where I'm leaning towards now is that when we do have this economic recession, it's not going to be like the tech bubble crash where it took freaking ages to recover, or the subprime mortgage collapse where, again, it was still as severe, but that was about a year and a bit. When we have this next hiccup, I think it's going to V-recover. It's going to tumble, just like every time we've had before, but they will start printing a lot faster than we think. And they'll come up with another bullshit term. It won't be QE, it won't be ZERP, NERP, or any of these. They'll have to create another thing. And I'm putting my bet on QS, quantitative support. So, yeah, TM, that's my name. And when you look at liquidity, so Michael Howard from Cross Border Cap, he's literally the world leader on global liquidity. He is, when you look at his reports and look at what global liquidity is actually doing, it's a lot different than what doom and gloom Twitter is basically telling us. All of the banks around the world are starting to ease off. So the red stuff is QT, quantitative tightening. And the green stuff is them loosening. This isn't printing. Printing will be more like deep, deep green. So you can see that the world of central banks is slowly easing. And we're seeing that with the first rate cut. Everyone else will follow suit. The UK didn't, but wait till the next one. We will. And it will go from rate cutting to eventually pumping once things break. And when I say breaking, I mean stocks having a proper wobble. And don't forget, if you just get rid of the Mang TM stocks, so Meta, Amazon, Apple, Netflix, Google, Tesla, or Nvidia, really, Nvidia is the main one. If you get rid of those 7, and Microsoft, 8, if you get rid of those 8 companies, the stock market's in a bit of a dire state, really. So the only thing really holding up everything at the moment is Nvidia. Nvidia is the market at the moment. So yeah, it won't take much for the S&P 500 to topple over. Again, look at global liquidity event versus gold. Gold is a lagging asset to global liquidity. It lags liquidity much slower than Bitcoin does, but you can see global liquidity, well, it's actually, this is the first time it's actually sort of front-run liquidity, but this is more for dilution concerns. People are they're running away from fiat, and when you run away from fiat, you have to run towards something else. And a lot of the baby boomers are fleeing to gold still for the moment. Just wait. There's lots of baby boomer crypto rappers coming out there. But yeah, same. Not much has happened. Again, the big charts, you have to go back to the big charts whenever you see the doom and gloom on Twitter. In fact, the big charts look doom and gloomy as well, but it gives you a much better indicator of where we're going, because a lot of the things you see online is like some random person's put up a chart and it's going, oh, this chart means the world's going to end, but people don't have context, which I'll show you in a minute. But I just want to re-emphasize the point that the interest-only repayments on the US national or federal debt is getting out of control. As we said, the official numbers we have at the moment is 1.1 trillion, but we all know that's when they revise that number, when they update the website, it will be closer to 1.5. So if you look at 2008, in fact, I've probably got these charts. I don't know if I'm going off script here. But yeah, long story short, US debt will always outpace M2. This is just pure maths at play now. GDP is going up, but that's only because debt is going up. It's the only reason. It's just you borrow your way out of it. Budget deficit, we've seen that as a percentage of GDP. It all looks horrible. But remember, with fundamental charts like this, it just takes a while for things to play out. But this is the crazy one. Like, US debt is north of 120% of GDP at the moment. The last time it was this bad was World War II. So, yeah, but the thing is, the M2's money supply was so low back then. Even as a percentage, M2 back then, it was pretty much 1 for 1. Now it's really gone out of control. So if you look at 2008, they actually had some sort of flexibility to have a little bit of control. You remember, central banks only have 2 levers. They either lower or raise interest rates, or they print or don't print. So in 2008, they had this liquidity crisis where they were struggling to roll over the debt, and they thought, oh, okay, maybe we should use some of these levers. So what did? They lowered rates to pretty much 0, and then they printed like crazy. So they just throttled both levers to the wall, basically. Those levers are still to the wall, and the governments and central banks, they like to posture that they have tools to change things, but they don't. Especially now that, as a percentage of income, the interest-only repayments are now close to 45% of income, whereas back in 2008 it was 25%. So they have to roll over the debt. It's just maths at this point. There's $350 trillion worth of debt sloshing around in the world right now. 350 trillion. I didn't believe that number when I first saw it. I was like, how can there be that much? It's 350, which means because most debt is on a 5 to 6 year cycle, the globe has to roll over $50 to $70 trillion of debt per year. They cannot do anything. They're just politicians. They'll just like Jerome Powell for all of this year said, no, we're going to keep rates high. We're going to keep rates high. And I was like, bullshit, bullshit, bullshit. Oh, they've dropped rates. Quelle surprise. So when shit hits the fan, they will print a lot quicker because things are a lot too, I mean, they thought it was too big to fail in 2008. It's much worse. US property looks like a bag of balls, basically. So that clanger is going to hit. US commercial real estate delinquencies are still going up. Again, it seems like the Federal Reserve website is getting slower and slower to update their charts. Whether that's on purpose or they're just, but they seem to be lagging either 3 months to 6 months in some respects. So, yeah.
100% on purpose.
Yeah, probably. And then we just come back to the liquidity chart. This is it. This is the chart that moves everything, and everything just happens to follow that, whether it's coincidentally put on top of it. And I agree with Harry. Harry's going to talk about, is the 4 year cycle dead? And I've said that this is the last predictable cycle. I genuinely mean that. And it just so happens, whether Satoshi knew it or not, he happened to put the 4 year cycle bang on top of the liquidity cycle. And he gave birth to it at exactly the right point. So, oh, sorry. Because I know on Discord and whatnot, it seems like Harry and I disagree with each other a lot, but we don't. It's just context. We agree on many of the same things. So, except, yeah, he probably doesn't like this chart. But this is, as I said, this is what I've been following for years, and this is the last predictable cycle. And then cue 20 personal messages a couple of weeks ago about CDD. I was like, oh, dear Lord. So what happened was there's someone on Twitter that posted one chart of coin days destroyed. And he was saying that, Bitcoin has peaked. It's not going to have another cycle. Left translated cycle bollocks kept re-emerging. And I was like, Jesus Christ. So this person is basically putting his whole trading portfolio actions on one on-chain analytic. which we know from prior experience that I put a lot less weight in on-chain analytics these days. So this was the chart that, this was the chart that went up. And what this person was saying is that, hey, look, this is CoinDays destroyed. Every time we see a peak in CDD, this is a market topping signal. And they're going, hey, look, it's just peaked. So it's basically Bitcoin peaked at 70 odd K. It's now going back down to 30, 40, or whatever. And I was like, no. So there's a few things I want to talk about here. So first of all, we'll come back to this chart. Hello, come in, please. Hey, please grab a seat. So first of all, if you did want to listen to this chart, please understand that this is a lagging chart in itself, and that if you were to exit every time CDD spiked, you will always miss out on at least 100% of gains, at least. Every single time CDD is peaked, this is the orange one, almost every single time, other than 2012 and 2014, it was pretty much bang on money. And this is a 90-day moving average, don't forget. So this is actually taken CDD and pushed it back to the left. But when it first spiked over here, Bitcoin was, this is a log chart, don't forget. So Bitcoin was, it's not even showing the price. Oh yeah, here. Bitcoin was sub 10K, and then it just carried on running up to, what was it, 20 odd K. And then the other time, it peaked again during the low. And then here it peaked, and I think it was around 35, 40, and then it carried on to 69. Now, what exactly is CoinDays destroyed? It's simply the amount of time a Bitcoin is held for. So, multiplied by the duration. So if you bought one Bitcoin and held it for 100 days, and then you moved it, that's 100 CoinDays destroyed. Make sense?
You have to move it or sell it. That's the whole.
Yeah.
That's the destroyed bit.
Yeah. Once it's moved, or sold. So you could buy half a Bitcoin and hold it for 100 days, and that's 50 CoinDays destroyed. Or you could have 0.1 Bitcoin for 100 days, and that'll be 10. By the way, I've kept that constant, but it could be for any amount of time. It's the amount of Bitcoin times by the duration, and that gives you your CoinDays destroyed. So when you go back to that chart, what it's basically showing is that the big money, or the people that have a lot of Bitcoin, they're obviously going to have a control of a lot of CoinDays destroyed when they start moving their Bitcoin, from wallet to exchange, etc. And so I guess the base premise of this chart is that, when the big boys and girls move their crypto, they're sending it to the exchanges to dump. And yes, there is some, sort of pattern here. But you have to look at the core data. This is simply a delayed indicator. This is the 90-day moving average. And anyone that are traders, right, puts a 90-day moving average on your chart and look how lagged and smooth that is. If you actually look at CDD, this is the hardcore chart. And what you'll actually find is that all these big boys, they're selling Bitcoin at a bit of a panic loss. So if you go back to here, so you had some cohort of big money that literally sold the very peak. Now, that could be insider trading, or these people could have started that crash. But you then have another spike where everyone panic sells, literally right at the low. You then have another peak here, but you can see all of these big peaks are after the first big crash has happened. Everyone goes, oh shit, Bitcoin's crashing, let's also dump. Most of the time it's post peak. Here you had, but then we start getting smarter money. So when you look at the big boys, and when I say big boys, I mean big banks, billionaires and whatnot, not Michael Saylor, because he will just buy and hold regardless. But the bigger boys, they're not trying to bottom pick and top pick. They will have set sort of distribution areas, as in profit-taking areas, and they will never get the high. Sometimes they're out of the market a lot earlier than the peak, but that's part of their course. So, oh dear. So you see a lot of sort of selling very early, but I think these sells are market institutions, basically, just they're sat on loads of profit. They're just getting out. They're using the retailers' liquidity as an exit liquidity. That's fine. You then have another bunch of people literally panic selling on the low, again on the high. And so what we've had here, which has shocked a lot of people, is that a lot of selling or movement around these areas. Now, when you put a 30-day moving average on it, all it's doing is taking the hardcore data, it's bunching all up into bigger chunks, and it's moving it left slightly. Now, as we all know with trading, you can curve fit any chart you want and get it to sing whatever tune you want it to sing. I could come up with all sorts of indicators and make the same chart really bearish or really bullish. So this is why you shouldn't base your market actions on one chart, especially without context. So that's a 30-day moving average, and then finally we get back to the 90-day moving average. And so, yeah, basically every time, if you were to use this chart, you would have lost out on a lot of gains from 8K to 20, 5 to 15, etc., etc. And also you do have pre-market high action. So just like this cycle here, you had a pre-market high and then obviously it 10x'd. Again, we had pre-market highs, so we had a bit of a bump up here on the way up, and then the cycle. So all I see this is pre-market high stuff. We are nowhere near cycle high yet. And I genuinely believe anyone that thinks like 75K Bitcoin is the top, they're missing a much bigger picture here, as in the global liquidity cycle and the fact that we're only just getting to the rate cuts. They will be printing like ridiculous, like we've never seen before.
Can I just
Yeah.
say something very quickly?
Yeah.
I know you don't want questions. What you've got to bear in mind also on the left hand, on the right hand side there, ETFs. Who's the biggest seller of ETFs at the moment? Grayscale.
Grayscale.
Imagine the size of their Bitcoin coins destroyed. So they have sold 500,000 Bitcoin, which they've held for 4 years. So that is going to spike that chart up, which is why it looks like. Exactly.
I completely agree with that. Grayscale are the liquidity providers for all of these ETFs at the moment. So, yeah, and here's the crazy thing. CoinDays Destroyed looks a little bit different on different sources. So these charts that I've been showing you are from Bitcoin Magazine Pro, which is where that original Twitter post came from. But if you look at CoinDays Destroyed on another chart like Check on Chain, it looks slightly different. So, and there's a few other sources where CoinDays Destroyed looks a little bit different, which I don't know why, because CoinDays Destroyed there's one true version, which is the actual stats. And I think how people have charted it is a bit weird. So I'm not sure how they've charted this one. So one of these two charts are wrong. It's either this is the correct one or that's the correct one. But either way, they're showing slightly different things. Now, a better version of CoinDays Destroyed is VDD, Value Days Destroyed. So this is a slightly smarter version because what they're doing is they're taking CDD times the price of Bitcoin. So it's sort of putting into the Bitcoin price and cycles, and it's slightly more accurate, but again, it's very early, it's sort of an early indicator. So it's basically, yeah, CDD times the price, and you'll see that every time VDD spikes, we're getting near-ish to a peak. But even though, if you take these bunch of spikes, it's still premature in terms of price. The market still pisses on off without you if you were to, again. So again, VDD has been destroyed here, but like you said, Grayscale is, that's been caused by Grayscale a lot. But where is it right now? It's in the gutters. So what I'm going to show you are a bunch of on-chain analytics that give you a completely different picture. And I'm not just cherry picking these. These are some of the on-chain analytics that I've used for a couple of years now, and they've been somewhat accurate. So if you look at the realized profit and loss, this I think is a much better picture, because when do people sell? They sell when they're in shitloads of profit, or they were in shitloads of profit and all of a sudden the market's tanking and they're like, oh, I need to protect my profit. So then you see the panic selling. What doesn't happen is people mass selling when they're already at big sustained losses. So we're basically down here at the moment. You only see market highs when this chart goes green like, yeah, green as this. Sorry, I'm trying my best to improve my language. My wife said I do swear a little bit too much, so or I'm a bit vulgar sometimes. So I am making a concerted effort to improve my potty mouth. So yeah, if it looks like I'm cutting my sentences short, I'm making a hard effort here. I just want to be myself. But anyway, cycle highs are when most of the market is in profit, and then we have a bit of a balloon pop, and everyone goes, ah, sell. We're nowhere near that. Yeah, we had a bit of a one, but again, we're still early in the cycle. And so that's measured in dollars. If you look at it in the amount of Bitcoin, it's an even better signal. We're nowhere near cycle highs. That is the overriding point I want to make. We are nowhere near cycle highs just yet. Nowhere near. If you look at the revived supply, older than 6 months, again, this is showing you the longer hands, the people that aren't just buying crypto, buying and selling. These are the people buying a lot more and holding for a lot longer. Again, this looks very similar to CDD, but again, we are still very, very low. And yeah, just look, this chart is basically the same as the profit chart I just showed you. The big, look, can you see, we need to get into this sort of area here before we see any cycle high or mass selling. But yeah. So it's all about the standard deviation. So if you see this line here, this is one standard deviation. So typically when we see a market cycle high, you see many orders of standard deviation excursions from this. So we at the moment, we are just pootling around in the normal zone. So if we then look at the pure multiple, this shows you minus stress. Are the miners stressed right now? Not really. Well, they are a little bit, but basically market highs happen when we get to this red line here. And this technically shows you when they are rolling in profits, when they're up here. So at the moment, the miners they're not being as profitable as they'd like to be, especially with this arms race going on with compute power. So ASICs are just getting better and better. So when this gets up here, that's a good market high. You can see every time we've got to this, here it's a 1.25 standard deviation. But it's a pretty good indicator of market highs. And we are at the bottom. And the pure multiple's been very accurate over the last bunch of years. MVRV, again, shows us that we're nowhere near cycle highs. Again, as I said, a bunch of charts which show us a completely different picture. Now, this is a new metric I wasn't aware of before. And by the way, there are hundreds and hundreds of on-chain analytics. And this is a new one to me. So I'm going to read it out because, so this is created by Checkmate, who's the head on-chain analytics person for Glassnode. And he said, before terminal price is calculated, it's first necessary to calculate transferred price. Transferred price takes the sum of coin days destroyed and divides it by the existing supply of Bitcoin and the time it has been in circulation. So what they're doing is that they're layer caking different indicators all on top of each other and then trying to normalize it across the future supply. The value of the transferred price is then multiplied by 21. Remember that there can only ever be 21 million Bitcoin mined. This creates a terminal value as the supply is all mined, a kind of reverse supply adjustment. Hello. So late.
Sorry.
Instead of heavily weighting later behavior, it normalizes historical behavior to today. By normalizing by 21, a terminal value is created. I think that's pretty cool. And again, what does the terminal price show you? Are we at a cycle high? Are we anywhere near a cycle high? No. Now, there is a diminishing returns that you can sort of see here. So before it had somewhat spiked beyond the terminal price, and now it's just sort of scraping. So I wouldn't be surprised if it doesn't even touch the red line on the next cycle high, but we are nowhere near there. This chart next year will be telling a much different picture. So that is my little sort of just chill the hell out. There's nothing to worry about. Even if there is a crash inbound soon, relatively soon, I think it's going to be a lot faster than you think. Now, obviously, the faster this crash happens, as in the sooner it happens, the better. So if it were to happen around November election time, great, because it then gives the market time to crash, the politicians and bankers to go, oh, what are we going to do? Like they actually have a choice in the matter. And then they start printing. The thing that does concern me a little bit is if there's a crash in summer 2025. So if we had a crash like end of this year or Q1 next year, everything is fine. You know, it's enough time for everything to crumble, everyone to panic, and then Bitcoin and crypto to absolutely boom to Q4 2025. But if there's a crash, say, summer next year, that does put a little spanner in the works. Now, one of the things which, oh, by the way, I finished my book, finally. One of the things I put in my book, oh, yes. Oh thank you, is that I realized I had this weird emotional attachment to Q4 2025. Now, that's only because of this first chart. 1 second. Sorry, we will get to Norfolk Steve in a bit. Oh, come on. Let's go back to the Old Faithful. The Old Faithful, here we go. So, because this chart has been so bang on for so many cycles, and we know that every Bitcoin high has been plus or minus 23 days from the 1st of December, roughly 18 months after the halving, I've always had this end of 2025 deadline. But I asked myself the other day, I was mid-typing, I was like, wait a minute. There's nothing solid about that date. Nothing. There's no like actual deadline. There's nothing that happens, you know, at the end of 2025 or plus or minus 23 days from the 1st of December. The only thing that makes that a thing is because of the last bunch of peaks. That is it. So as a deadline, when you look at it from a stats point of view, it's a very flimsy deadline because it's got 1, 2, 3 data points over the last 10 years or so. So I was saying to myself, wait a minute, okay, so this 1st of December thing, 2025, doesn't have to really exist. I mean, it can deviate that, so if there is a crash summer next year, I don't think that changes anything. All it'll do is it'll just push things back. Remember, and I said this a while ago, the 4-year cycle just happens to have been set on top of the global liquidity cycle, which is a 5 to 6 year cycle. And a lot of people, you know how people are saying, oh, the Bitcoin cycles are lengthening. Are they lengthening? Or is it just because it's put on top of a 5 to 6 year liquidity cycle and the 4-year, so of course it's going to slowly go out of whack, isn't it? So for the first bunch of cycles, yes, it may look, oh, bang on time with the liquidity cycle, but eventually it's going to get out of favor, which is one of the reasons why I think a lot of people think that the Bitcoin cycles are lengthening. I don't think they are. It's just the liquidity cycles on a 5 to 6 year cycle. That's it. So personally, in my mind, I'm putting a lot less weight these days on this big fat, not that line, this line here, the 1st of December 2025. Just because actually from a stat perspective, it's quite flimsy. And there's nothing economically saying that. There's nothing in terms of on-chain analytics that goes 25th of December 2025. It's just been that nice, you got to plan a trade and then trade the plan. Q4 2025 has been the plan for a while. Now, the one thing that will adhere, the one chart that you should look at, and you're just going to roll your eyes when I put this chart up. I haven't even, yeah, I haven't even put it here because I knew it would just be like, oh, God's sake, Siam, stop talking about that chart. It's Siam's smooth brain bullet points. That is the chart you need to look at. That is the only logical sequence of events that will happen, and deadlines and timelines are irrelevant. It is a case of rate cuts, probably some sort of market crash, mass financial stimulus. Bull market highs, we all sell and leave the UK because of CGT concerns.